Hi. So, if you've talked to us lately, you've probably heard us say it's not quite the right time to be in bonds, right?
Correct.
It's been a while too of us saying this, but one of the silver linings to where we are in this point in financial history is that with the Fed raising rates, it really changes the outlook for bonds. So today we're going to talk a little bit about that. Here we have our trusty tool, the dolly. Doug, do you want to walk us through it?
Yeah, so basically we're seeing that bonds, well, let's go to the top right now. We've been saying commodities are the place to be, and that's showing. And we still are putting people into commodities. And then cash, we haven't really raised cash because I think it's a temporary thing. And then U.S. equities are next. We have people in U.S. equities primarily in energy, consumer cyclicals. Those are the areas that we've been putting most people in. But then the next one, which wasn't there, was international stocks, but it's been flipped, and now fixed income has moved up. And where fixed income was at the bottom, it's now third from the bottom, it's moving up. And I think we're coming to a point where it's showing that we'll be able to invest in fixed income or bonds soon.
Which is wonderful. I mean, there are a few guarantees in life, and there are a few, bonds aren't necessarily a complete guarantee, but at least it's a...
Well, we should go to our next chart and show why we've been negative on bonds.
Yes.
And what this is this is the TLT, which is a ETF that's invested in 20-year treasuries. So we're using it as an index. We're not recommending it. We're just using an index. But this shows the last 2 years, you've seen a 45% loss in principal, which really makes it a little more risky than the stock market.
Which is wild. So you get the fixed income from it,
but
the underlying investment itself loses value.
And we should talk about why that happens.
Right.
So bonds are like a teeter-totter. When interest rates go up, the value of your bonds go down. Likewise, when interest rates go down, the value goes up. We've been saying that interest rates near zero in they hit zero in 2020. There's only one direction the interest rates could do, and that's up.
And I mean, just to add to that, effectively interest rates were in the negative if you think about how high inflation was and is. And when you have zero rates, you're actually losing money.
Because you're not keeping up with inflation.
Right.
And then, so we knew interest rates had to go up, and so when interest rates went up, the value of your bonds goes down, and this demonstrates it. A 45% loss, yet there was a large amount of people who were invested 60% in stocks and 40% in these 20-year bonds.
I actually read the other day that the 60-40 portfolio, which is 60% equities, 40% bonds, this was the worst year since the Great Depression for that sort of portfolio.
Yep, most investors, that's what they had going into this. And we were very much against the 60-40 all the way through. We were, in fact, against bonds all the way through. But I think we're going to be going back into bonds soon.
Yeah.
So, if you'd like to learn more about what we think about bonds and bond funds and different types of investing in bonds, please give us a call. We'd be glad to help you out. I think that's good too.